Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, July 8th, 2013. And in this video, I'd like to talk a little bit about trends, what trends are, some of the different metrics I use to help evaluate the current trend. And, I'm doing this video today, actually, because I think that we may be at an inflection point here in the market. Currently, I have us on a short-term downtrend. The intermediate term trend, which is probably much more important to the majority of traders, especially swing traders or investors out there, that trend is close to signaling the first sell signal or change to a downtrend in a while. So we're going to talk on that as well. Before we get into the different trends, let's talk about what a trend is. If you look up the definition, there's various definitions online. Investopedia defines a trend as the general direction of a market or the price of an asset. And trends can vary in length from short to intermediate to long term. How do we determine the trend on any given time frame? Well, that depends. There's different ways to do it. Trend lines are a simple method. Anybody who's followed this site or has done any trading or basic charting, I'm sure you use trend lines to help determine trends, uptrend lines, downtrend lines. Another method is simply prices, looking at prices. My general definition of a trend is when prices are making a series of higher highs and higher lows, that's an uptrend. Or if prices are making a series of lower highs and lower lows, that's a downtrend. It's as simple as that. But again, different metrics used by different traders. One other commonly used measure of a trend are moving averages. For example, a 50-day or 200-day moving average on a chart. When you look at a price chart, particularly candlestick charts, my preference is to use candlestick charts. It can look like a lot of noise. You have a lot of seemingly random movements in there, and that's where moving averages come in. They help smooth out the day-to-day gyrations. So that's another way to easily eyeball a trend by using a simple moving average. Now, more importantly, our trend changes. How do we recognize when a trend has changed or when a trend is likely to change? There are a lot of services out there, that are what I refer to as trend chasers. Always preaching the trend is your friend, trade with the trend. Well, the problem with that is by most metrics, once a trend has changed, once you wait to see prices have made that series of let's say we've been in an uptrend for a while and prices have reversed and are now making a series of lower lows and lower highs. Well, that can take often weeks, if not months, before one can clearly say that we are now in a downtrend. Same with a moving average. If you're following a moving average like the 200-day moving average, it takes a while for that moving average to flatten out and then turn down. And by that time, especially if there's a sharp correction in the market, and you remember that prices often fall much faster than they rise. When we have corrections, it's not uncommon to see months of gains wiped out within mere days, sometimes weeks. So it's important to really, in my opinion, get a heads up on not just identifying what trend you're in now. That does help to align your trades with the current trend. That is important. But helping to recognize when a trend is likely to change. So that's what we're going to talk about today. Okay, what we're looking at here is one of my layouts. This is I call it my quad trends layout. You can replicate these on your own charts, charting programs, name them whatever you want. But basically, we're looking at 4 trends here, and starting from the upper left, if you follow my cursor, we have these are your long-term trends up here. Both of these, a weekly and monthly trend. So they're identified because this is a monthly period chart. I'm using the SPY here. You can use the SPX as well. And here's a weekly trend. So these are your long-term trends, and this is for the trader investor. I should say investors, not traders. Somebody who's going to sail around the world and keep an eye on their investments, maybe every time they come into port every few weeks, and make sure the trend is either still up or down, so they're positioned accordingly. But for those of you who like to trade more actively or manage their investments a little more actively, we'll really focus on these weekly, daily, and shorter term trends. So let's walk through these one at a time. Let me go ahead and expand the monthly trend here. Okay, so what we're looking at here is a monthly chart of the SPY, the tracking ETF for the S&P 500. The black dotted line that you see here, this is the price of the SPY over time. And overlaid on top of that are two moving averages. We have the exponential, the 10 period exponential moving average. Once again, that's a monthly 10 EMA, and the 6 period moving average, so the monthly 6 EMA in purple. So we have the 10 in blue and the 6 in purple, and it's as simple as this. Using two moving averages, you look at a crossover, and when you have the shorter period, which in this case is a 6 EMA, on top of the 10 EMA, that is an uptrend, and that's a buy signal. And remember, we're looking at a monthly chart. So down here on the scaling, each of these are years. Here's this chart goes back to 88. So here's 89, 90, and pretty much you'd be long at that point. And you can see the crossovers. Now, I realize if you're viewing this video on YouTube, I can only make these videos so big. YouTube has a maximum cap on the size. I use much larger monitors, so even right now I have this shrunk down quite a bit on my monitor to take a look. So what really helps is I've created this custom histogram down here that shows the crossovers. For any time that the 6 EMA is above the 10 EMA, you have the histogram bars green. Very similar to your MACD histogram. And once you get a crossover, the 6 crosses down below the 10, the histogram goes red. So as you can see here, this method alone, as simple as it is, was very effective in keeping you long throughout the 90s without a single whipsaw. I don't believe there may be a very tiny red dot right here. So it's, yeah, I think there's one tiny little whipsaw signal back there. But for the most part, a nearly perfect indicator throughout the 90s. Got you out of stocks back in, right around the top. Really just very shortly after the market peak. Let me get the crosshairs right on that first histogram bar. There you go. That was our sell signal. Kept you short, or for those of you who don't short, kept you out of the market up until this time and then got you back in here. So as you can see, very simple yet very effective long-term indicator. And now we'll jump ahead and look at the weekly. Okay, this is again a long-term trend indicator, but instead of using a monthly chart, we're looking at a weekly chart. So you have a different set of moving averages here. This is the 43 and 17, again exponential moving averages. The long moving average is the 43, is defined by this purple line, and the 17 is a green line. Once again, I have the histogram down here so you can clearly see where the crossovers occurred. If you follow the vertical line, you'll see that's where prices crossed when the histogram went red. Now what you get when you move down to the shorter time frames, the signals are going to come earlier. You're going to get a sell signal much sooner than you would by using this weekly chart and these faster set of EMAs. You'll get a sell signal earlier. You'll also, as you move down in time frames, the frequency of whipsaws or false buy and sell signals will increase as well. So I just wanted to take a look at these. These longer term charts, of course, the sell signals and whipsaws are pretty much very infrequent, relatively speaking. As you can see here, back in 2008, it got you short pretty early. That was in January, mid-January was our sell signal. Kept you short throughout most of the downturn, or I should say throughout the entire downturn from that point. But as many indicators, or I should say moving average pairs do, I find these much more effective as buy signals to get you, I should say sell signals to get you out of the market once we have a correction. and I also like to get ahead on these signals sometime. I'm going to talk on that in a little bit. But I often will cover my short positions and reverse long based on many other factors on the chart, such as positive divergence and other things that I can tell you had clearly set up at this point. We had strong positive divergences going into the lows, so although this signal would have kept you shorting, there were other signs, other metrics, other trend indicators that I use that didn't keep you short all the way until this signal finally gave you a buy. But once you get the buy signal, it pretty much gives you the all clear that now this was more than just a correction within an ongoing bear market, that this was an actual bottom, and that the trend, at least on the weekly time frame, had changed. And as you can see here, this would have kept you long or told you that the trend was up all the way until mid 2011, where it gave the next sell signal. So again, very few whipsaws, very effective, especially for capturing the meat of a trend or of the move, whether it's up or down. And as you can see here, we're clearly, from a longer term perspective, the uptrend is clearly up at this time. So we're going to zoom down now, take a look at some of the daily time frames, the shorter term sell signals. Okay, so we covered the long-term trends on both the monthly and weekly time frames, and now we're looking at the intermediate term time frame. We're looking at a daily chart of the SPY. Once again, the black dotted line is the SPY, or the S&P 500, how it's done over the last couple years. This is a nearly 2-year span we're looking at. And on this chart, the set of EMAs I use are the 50 and 20. So again, we have the histogram here to help define those crossovers. And as you can see here, this has done a pretty good job. Now, when you go down to these shorter term time frames, you're going to have a lot more signals. You're going to have more frequent trend changes, because the weekly and monthly charts, those are capturing the primary trend. The major bull and bear market moves. When you go down to the weekly chart, you don't have all the little corrections that you do on the daily charts, but you will catch some of the bigger corrections like we had back in 2010 or 2011, I should say. So we're looking at the last couple years here, and you can see it's done a pretty good job. Doesn't get you in right away, but this is something I wanted to talk on. This will tell you what the trend is. We all know that the trend has been up for some time. That doesn't take a rocket scientist to tell you that the trend throughout 2013, at least up until mid-May, has been up. Now we can do one of two things. You can wait for a confirmed crossover of these EMAs, and that will tell you that we're now in a intermediate term downtrend. However, the problem with that, the problem I have with these EMAs, is if you take a look, just follow the vertical line. What I'm going to do is place it on the sell signal when the histogram went negative, or when the lines crossed over. And actually, let's look at my crosshairs. That's where it would have told you to exit your longs or short the market. Now look where the market actually peaked, way back here, a couple months earlier. Still, at least you avoided some pain. Yes, there was some more downside. And if you use this strategy alone, which I don't recommend using any simple strategy like this as a standalone buy and sell signal, it got you back in around the same point that you got out. So you really didn't profit much on a short trade. And if you held on to your longs, I should say, even though things dipped down, you were right back to where you started. That probably didn't come out very clear, but pretty much the re-entry point, the new long signal, or at least when it was clearly a buy signal, when the histogram turned green, these lines sort of flattened out for a little bit. You had a couple weeks there where it was almost indeterminable if they had crossed yet or not. Let's take a look over here. We had back, this is late 2012, and I'm trying to move that over. It told us, you have to wait till you actually see the bar cross negative, and that's going to be on a daily close. So it would have got you in somewhere around there. Yes, there was a little downside, but by the time it told you to get out of your shorts, prices were back already above where they were. So again, and this is what I wanted to reiterate or impress with these signals, is that they're not standalone get in, get out of the market signals. And where I find them most effective is in combination with other metrics, other things I'm following, such as the things I've been harping on for months now, on the SPY, for example, the long ascending channel that we were in, which broke down, and today we're currently back testing. We had negative divergences. There were a lot of other things that, I made a pretty good case that prices were going to break below that channel, and they did. And so we were, a lot of the shorts were talked about up here at the top when the channel was being overthrown. Now, if you look at this, you can see there is some, a pattern in these signals. You typically have uptrends that last for several months. This one, other than this very short whipsaw back in December, this goes back to 2011. From about November all the way to May, the market was in clearly, at least defined by these intermediate term, moving averages, in an uptrend. And this was our sell signal. However, you can see as the slower or shorter EMA began coming down, we have the histogram coming down, we could tell that a cross was pending. There are no guarantees. I have seen these once in a while. You'll see these moving averages come down. Looks like a cross is imminent, but we have a bounce or a very brief whipsaw. But for the most part, if you did this 9 or 8 out of 10 times and you see several months where the market is strong, you have that shorter term moving average above, and then all of a sudden the momentum turns and the shorter term moving average starts quickly coming down, you can, as I said, 8, maybe 7, 8, 9 times out of 10, you're going to get that crossover. And so this is where I start getting short. This is where I start looking for shorts, again, in conjunction with many other things. If the overall charts are looking bearish, I see trend line breaks, rising wedge patterns, negative divergences, all these other things. So I still find these useful because I can, as we look at this now, let's look at where we're at today. A crossover is, I would say, pending. Lines are starting to flatten out. Sometimes we do see that when the quicker moving average comes down for a sell signal. Now we may bounce. We don't have that sell signal yet on the intermediate term time frame, but with it would only take a couple of sharp days down in the market, or maybe if we close down substantially this week, that will more than likely trigger that crossover and give us the first sell signal that we've had on the intermediate term time frame in a long time. And again, based on the other things I'm seeing here right now as I speak, today we've back tested the recently broken ascending channel in the SPY, SPX, and those are things that I look at. So just wanted to take a look at this, and I put a lot of focus right now on this intermediate term time frame. This would be probably the most important moving average pair that most traders who follow the site, my own trading style, I'm mostly a swing trader where my average holding period is measured in weeks or months, and this is, for that purpose, probably the most effective moving average combination. Before we move off that, this is a different chart. The other program I use, TC2000, I love that program. It's very user friendly, has a lot of nice features, but the biggest limitation is that you can only go back 200 bars in time. So when I'm looking at a daily chart, your limitation, you can go back to only 2 years. I use a lot of other charting programs, and this is one of them here. This is that same SPY daily chart. Here's a SPY right here, except we're going back 5 years. I can go back, I think, up to 25 years on this charting service. And although I can't replicate that histogram, but you can see down here again the 20 and 50 EMA, and see how effective it's been in the past. Here was our sell signal back in the bear market in '08, where those lines crossed. The 20 crossed below the 50, kept you short all the way until this point, and then crossed over, made a bullish crossover, and as you can see there, came back, tried to, came down towards that 50, but never crossed below. So it kept it on a buy signal all the way to here. We had a brief whipsaw, but put you back in long. So you can take a look and see here. It's very effective. I should say fairly effective in keeping you on the right side of the trend, especially on this intermediate term frame here we're talking about. And what I note is you typically have about 6 months of strong trends before you get those crossovers, even if they're only good for a tradable correction. If you're pretty nimble on the short side, or you want to book profits on longs, this tells you when that 20 EMA is above the 50 for such a length of time, and then it starts curling down, you're more than likely going to have a crossover. And that's where we're at today, folks. It's been, throughout this entire year, we had this bullish cross back, I think, in November, and this bull run's getting pretty long in the tooth, and that 20 EMA right now is flirting with the crossing below the 50, and if we get that, it'll be a bona fide sell signal and put us on an intermediate term downtrend. Okay, now let's go ahead and take a look at the short-term downtrend. Okay, this is my short-term downtrend screen. Was that first the lower left or the lower right quadrant on that quad chart that I had, the quad trend layout. Over time, I'm always experimenting with moving average combinations because over time market conditions change, and what worked yesteryear may not work 2 years from now. So over time I do like to change, but one thing that's pretty consistent is this 20-day moving average. Again, this is a 20-day exponential moving average, and simply one second. Sorry, a little distraction there with the phone. Okay, we're looking again at a daily time frame, I should clarify. And with the 20 EMA, it's as simple as this. If the 20 EMA is moving up, you're in an uptrend. And when it's moving down, it's defined by the slope. When it slopes and turns downwards, that's typically a downtrend. Being that it's such a shorter moving average, but it's only a 20-day and it's an exponential moving average, so those will tend to move a little quicker than the simple moving averages. You do get quite a bit of whipsaws, so I like to scrub it with a few combination pairs. This is a 39 and 13 EMA pair. I don't show those lines up here, but if they were, this would just represent the crossovers. But as you can see here, using this, being it's a short term, it gets you in a lot closer to the top. Let's just take a look at a couple of these peaks. Here the market peaked back in, this is 2011. Looks like very late October we had a peak. Another peak not too much higher in early November. And it was just shortly after that, about another week after that, that the 20 EMA turned down and would have got you short, or signaled that the short-term downtrend, or the short-term trend was now down, and that would have actually allowed you to catch that nice sharp drop right there. We turned up here, and again there are a couple whipsaw signals, but for the most part here was a strong trend. Kept you long that whole time. Turned down here, kept you short throughout most of this move, and as you can see, it's worked out well. So prices now have peaked. It was, I believe, May 22nd is when the SPY and the S&P 500 topped, and as you can see, since then, let's zoom in a little bit, the 20 EMA has been moving lower. Just in the last few days it curled back up, but as I stated on the site last week, I put the week of July 4th as about as insignificant as the week of Thanksgiving and Christmas. Those are those 3 weeks are notorious for the big boys taking vacation. The big boys being the players, the traders on the street, and especially the short traders that affect the market are largely the institutional traders, not the retail traders. So those guys go out to the Hamptons, do what they do. They're not shorting stocks, so you tend to have an upward bias in those weeks. They're low volume trading weeks, so I don't put too much stock into what happens That's why I didn't do a lot of trading personally last week. So, but with that being said, price action is first and foremost, and we did move up last week. Again, it doesn't surprise me, and it did turn this 20 EMA up now. So I'm on watch. The short-term trend, at least as measured by this, is now up. So at this point, although we are back testing that recently broken ascending channel on the SPY, I'm not aggressively adding shorts right now. I want to see this line turn back down. However, if we look down here at my 39.13 EMA crossovers, that confirmed. That usually comes in a little after, in confirming a buy or sell signal. It comes in a little after the 20 EMA. The 20 EMA is much faster. It's a single moving average, so it's going to turn down. It doesn't need a shorter period to confirm it, as with this 39.13 combination here. But that 13.39 combination did confirm and still has us, as you can see here, not by much. And this is why I mentioned in the blog today, if we see a lot more upside, this short-term downtrend is now going to revert back to up. And at that point, it can easily be a whipsaw. We see that happen. Here's a case over here. We see sometimes. Actually, I'm sorry. There's not many whipsaws on this one I have here. There's a couple others that I've been watching where we've seen some whipsaws recently. But either way, if that goes up, then I'm a little more cautious in adding short exposure, and I'm a little more apt to take longs. Although I would like to see more than just a couple days of it break to the upside here. So again, something I'm looking at. These have been our sell signals on the shorter term time frames, and if you just look up above at prices, as you can see, they did a good job of getting you in. Once again, as I talked about with the intermediate term time frames, I like to look at the trend, and I can see, when the momentum's waning, you can see the histogram start to drop down, and it doesn't take a rocket scientist to see when a cross is very likely to happen. So I usually don't wait to see this happen to short. I'm usually shorting once I've seen an extended run with the shorter term EMA above the longer term, and then the momentum waning. And again, that is factored in with many other metrics, such as trend lines, other technical patterns like rising wedges. The MACD is a great momentum indicator. So there we are, and I'll just take a quick look at this. Here's another pair I like to use. The 26.13 EMA has done a good job, and this is the one I mentioned. Sometimes you get some whipsaws. If you look back here, you did get it's a quicker set of EMAs, so it did get you in short earlier. It got you short back here in 2012, much closer to the top. But it did give you this little whipsaw that shook you out, and I could see that happening here. It may or may not happen, but either way, if we do turn green on these histograms, then again I'll be a little more hesitant to add short exposure, and may start stopping out of some of the current short positions I have, or at least tighten the stops up. Okay, and to wrap this video up, let's just take a quick look at the SPY. And again, the moving average, single moving averages and moving average pairs that I talked about are just one of many metrics in determining a trend. Trend lines are probably the single most effective. They're very easy to draw. I've covered, this is my daily SPY chart. And you had these series of uptrends here defined by these channels. I had midpoints drawn in these channels, and when prices break below, here's the breakdown of this first channel. We began a new downtrend. Prices broke below, came up, back tested, new downtrend. We've been in this long extended channel. Prices have broken down below, which I've talked about extensively lately, and we've now come back to back test that channel. My expectation is that prices continue lower. Other simple visual metrics of viewing whether the trend is up or down, or let's take a look at the money flows. Here's a CMF. When money flows are positive, you're typically in an uptrend. Once money flows taper off and become negative, that begins your downtrend. So here we are, uptrend below the channel, and here's a downtrend, uptrend, and look at the money flows. They started going negative shortly after the market peaked, and they continue to be negative right now. So this helps reaffirm, at least in the shorter term, that we are in a downtrend, regardless of this rally that we've had in the last couple weeks here. oversold rally. This is another one I've talked about as well. It's very simple but effective. The zero line on the MACD and on the daily time frame. When the MACD is below the zero line, tends to be bearish territory, or in other words, we're in a downtrend. So again, I've talked about this in the past, but this has done a good job if you look at the horizontal line of marking those downtrends. And once the MACD goes above there on the daily time frame, above that zero line, tells you that the downtrend is more than likely over. At least that's been, the history over the last few years here. Okay, and the final chart to wrap it up is this. Oops, I have to move that down a little bit. This is the SPY 4-hour chart. Simply zooming in a little closer to that ascending channel, showing the back test here today. Again, maybe we push a little higher. Things that I'm watching, we're starting to see the MACD get out of this bearish zone, getting close to crossing over, into positive territory, but we're not there yet. So I think, based on everything we've looked at, a lot of these indicators show prices go much higher, and which they may. Let's draw one more thing. Okay, let's see. I wanted to add this trend line. Let's do that. Remember, one of the most simple and effective definitions of a downtrend is a series of lower highs. Here's our high back on May 22nd, the next reaction high, and where we're at today. And I just added this downtrend line in here. Now, we could still take out that downtrend line, and unless we take out this previous reaction high, which was back on, I think I mentioned this in the blog in a static post, that's June 18th right there. If we take out that high of 165.99, now the market has made a higher high, and we no longer have a series of lower highs. But as of now, we have a series of lower highs and lower lows. Here's a low, another reaction low, another reaction low. So if prices turn down here, and especially if they take out this low from June 24th, then the short-term downtrend is solidly intact, and as I just discussed earlier, this would almost certainly trigger a sell signal in that intermediate term chart that I talked about with the pair of moving averages. So this is something to watch for, and this is why I think we're at a very critical inflection point, because if prices go much higher, not only will they regain this channel, they're going to take out that previous reaction high, and we're going to have a lot of the short-term trend indicators that I have will put us back on a positive or bullish short-term uptrend. Okay, folks, this has been Randy Finney with Right Side of the Chart, and I hope you found this useful. Have a good day.